Every few decades, the world goes a little insane over rocks, metal, and oil. Copper suddenly isn't just wire in your walls, it's the new gold. Oil isn't just fuel, it's black treasure. Grain, lithium, nickel, uranium. Prices explode, headlines scream supercycle, and governments start talking like they've struck the jackpot. And then, just when everyone has adjusted to the new reality, the music stops. Mines go bankrupt. Ghost fleets of idle tankers sit offshore. Cities built on resource money crumble. The same politicians who promised a new golden age quietly disappear from the front page. So what is a commodities supercycle, really? A miracle of growth? Or a slow motion trap? Money, power, and history collide here, and nothing is ever as simple as it looks. Commodities aren't just stuff pulled out of the ground. They're the bloodstream of the global economy. The copper in your phone, the diesel in your food supply, the wheat in your bread, the lithium in your battery. Every product you touch is a story of dirt, extraction, and transport. Most of the time, this bloodstream flows quietly in the background. Prices bounce around, traders get excited, a few economists argue on TV, but life goes on. Then every few generations, demand for that bloodstream surges so hard that prices don't just rise for a year or two. They stay elevated for a decade or more. That's what people call a commodity supercycle. A long stretch where rising demand and years of underinvestment collide, prices stay high, fortunes are made, and then, inevitably, wiped out. Because here's the uncomfortable truth. A supercycle isn't just about boom, it's about the bust that has been quietly building from day one. To understand how this really works, and who actually wins when boom meets bust, you have to go back to the beginning, to the first time the modern world realized it could get rich by pulling more and more out of the ground. In the late 19th century, the industrial world was hungry. Railways snaked across continents, telegraph lines wrapped the planet in copper wire. Cities demanded steel, coal, electricity. The United States, Britain, Germany, all of them were racing to industrialize faster than their rivals. But booms are not born on the front page. They are born in boredom. For years before those famous commodity booms, prices were low, mines closed. Investors moved on to more glamorous stories. Geologists were ignored, survey maps gathered dust, and the assumption hardened that tomorrow would look like yesterday. Then the world changed. New factories opened, new empires emerged, new technologies devoured metals and energy. Demand didn't gently rise, it lurched upward. Suddenly, the quiet mine at the edge of town became the center of the universe. The coal nobody wanted last decade became indispensable. The same copper deposit that barely paid its workers now made its owners rich. And from that moment, the clock started ticking. The first rule of every commodities supercycle is simple. The cure for high prices is high prices. When prices jump and stay high, they send a signal. Entrepreneurs wake up. Capital comes rushing back in. Projects that once looked insane at low prices suddenly look visionary. The world discovers that it's full of marginal deposits that can be mined, drilled, or harvested if the price is right. Fast forward to the years after World War II. Europe and Japan were in ruins. Bridges bombed, factories flattened, power lines shredded. To rebuild, they needed everything at once. Steel, copper, cement, coal, and above all, oil. The United States poured money and material into its allies. New highways, ports, and power plants were built. The global economy didn't just recover, it transformed. Billions of human hours shifted from farms to factories and offices. That transformation rode on the back of bulk commodities. Once again, prices rose and stayed high. Exporters felt invincible. In mining towns from Chile to South Africa, in oil kingdoms from the Middle East to Venezuela, it felt like history had finally chosen its winners. But behind the celebration, the old pattern was quietly forming. Governments assumed the boom was permanent and built budgets on peak revenues. Companies borrowed heavily to expand capacity. Banks happily financed anything that smelled like resources. Then came the 1970s, and a different kind of shock. Oil producers, led by OPEC, looked at a world utterly dependent on their wells and decided to test just how powerful that dependence was. Embargoes, price hikes, supply cuts. Overnight, oil went from cheap and boring to scarce and explosive. For oil exporters, it was a revelation. Rivers of petrodollars flooded in. Capitals that had been dusty outposts became symbols of modernity. Glass towers, multi-lane highways, airports in the middle of the desert, all paid for by what lay under the sand. For importers, it was a nightmare. Inflation took off, long lines formed at gas stations. Entire political careers rose and fell on the price of a barrel. The story of the decade became energy scarcity, and the phrase running out of oil turned into a kind of secular apocalypse. Experts declared that the age of cheap oil was over forever. They wrote thick reports and confident books explaining why high prices were the new normal, except they weren't. Those same high prices did what they always do. They triggered a wave of exploration in places that had been written off. The North Sea, Alaska, offshore platforms in hostile waters. Engineers found ways to squeeze more miles out of a gallon, more light out of a kilowatt, more output from each unit of energy. By the 1980s, the world that had been terrified of permanent scarcity was drowning in supply. Oil prices collapsed. Nations that had built their dreams on 70s prices woke up in 80s reality. Some never fully recovered. The script was clear, but the world was not finished with this story. Roll forward to the early 2000s. This time, the shock had a new name: China. In less than a generation, hundreds of millions of people moved from villages into concrete apartments. Skylines erupted from nothing. Highways, ports, railways, power grids, all built at a speed no previous empire had managed. To feed this machine, China devoured raw materials on a scale the world had never seen. Iron ore from Australia and Brazil, copper from Chile and Zambia, coal from Indonesia, oil from everywhere. Container ships grew larger. Bulk carriers lined up at ports, waiting days just to load. Prices exploded. Iron ore multiplied in value. Copper broke through old ceilings. Oil surged past levels once considered unthinkable. Commentators dusted off an old phrase and put a modern shine on it. Commodities, supercycle. In Brasilia, Canberra, Luanda, and the Gulf, leaders made speeches about a new era. This time really did feel different. After all, this wasn't a war or a temporary reconstruction. This was the industrialization of a fifth of humanity. Money did what it always does in these moments, I believed. New mines were approved. Deepwater oil projects costing tens of billions of dollars were greenlit on the assumption that triple-digit oil prices were here to stay. Entire national development plans were written around the idea that China's growth curve would remain steep forever. On top of the real physical demand, something else was happening quietly but powerfully. Finance had fully moved into the warehouse. Commodities, once mainly the domain of producers and consumers, became fashionable financial assets. Funds allowed investors to own copper, oil, and wheat on paper. Indexes were created. Derivatives layered on top of derivatives. A market built to stabilize physical trade became a casino amplifying every move. As long as China boomed and the story stayed intact, it all worked. Then growth began to slow, not collapse, just slow. Instead of accelerating each year, demand started growing at a more normal pace. That was enough. Suddenly, all those projects launched at peak optimism met a cooler reality. New mines, oil fields, and smelters kept coming online even as demand growth eased. Supply caught up, then overshot. Prices cracked, then tumbled, then plunged. Iron ore giants abandoned smaller projects. Junior miners vanished. Resource-heavy currencies sagged. The same analysts who had promised a decade of endless upside quietly rewrote their reports. The pattern repeated, almost line for line. Neglect, shock, boom. Overbuild, bust. Underneath all the charts and forecasts, commodity supercycles are remarkably human. They are stories about how people react to scarcity and abundance, to fear and euphoria. At the start, nobody wants the thing. At the peak, everyone wants more of it than actually exists. Who wins inside this loop? It's easy to say the resource-rich countries, and for a while that looks true. During the boom years, tax revenues surge. Currencies strengthen. Imports of luxury goods explode. Governments announce free education, cheap fuel, generous pensions, vast infrastructure plans. But history is cruelly honest. Many of the countries that seemed richest at the top of the cycle look fragile and hollow once the dust settles. Budgets that depended on windfall revenues start bleeding red ink. Subsidies that bought political calm become unaffordable. Projects built to showcase national greatness turn into maintenance burdens nobody can fund. The winners are narrower and more disciplined. There are traders and companies that sell into euphoria instead of buying it. Countries that channel temporary revenue into sovereign wealth funds instead of permanent entitlements. Individuals who treat a boom as a windfall to be banked, not a lifestyle to be normalized. The losers are also consistent. Governments that believe their own speeches. Households that take on big debts at the top of the cycle, convinced that high wages and easy overtime will last forever. Regions that bet everything on one resource and wake up to find the world has invented a substitute. Look at any boomtown built on a single commodity, and the story becomes painfully concrete. At the peak, wages in the mines or fields double. Restaurants are packed. Real estate agents can't keep up. Local officials approve new stadiums, fire stations, schools, airports. Crime drops. Optimism rises. The future feels guaranteed. Then prices fall. Not overnight in a cinematic crash, but in a grinding, morale-crushing slide. Overtime disappears first. Then temporary workers. Then the whole shifts. The town's tax base shrinks just as its obligations peak. Projects are left half-finished. Houses sit empty. People who can move do. Those who can't are left staring at for sale signs that never come down. The bust isn't a separate story from the boom. It is the boom's second act. Every stadium built without asking what if becomes a liability. Every public salary raised on boom revenue becomes a promise that someone will have to break. Every business that opened to serve miners and drillers now has a front row seat to the downturn. Economists have a phrase for this paradox: the resource curse. The idea that having abundant commodities can actually damage a country's long-term prospects if it encourages complacency, corruption, and a lack of diversification. The curse isn't in the barrel of oil or the ton of copper. It's in the choices made when those barrels and tons feel like a magic solution to every problem. Modern finance adds another twist. The tools created to hedge commodity risk, futures, options, swaps, are powerful and useful. A farmer can lock in a future price for grain. An airline can hedge against fuel spikes. A miner can stabilize cash flow. But when speculation overwhelms hedging, the market stops reflecting reality and starts distorting it. Waves of capital chasing short-term trends can exaggerate every move. Rising prices attract speculators whose buying pushes prices further, which attracts more players, which drives more headlines, which pulls in the last wave of latecomers. When sentiment turns, the exit is narrow. Forced selling pushes prices below what physical supply and demand would justify. Producers and consumers who never speculated at all are dragged into the consequences. It is like attaching an amplifier to the heartbeat of the real economy. Every pulse becomes a spike. So what actually survives when the dust settles? When the supercycle is over, when the mania has burned out and the bust has done its work, what remains? History's answers are surprisingly consistent. Real, productive assets survive, if they are low cost and efficient. A mine at the bottom of the cost curve can endure brutal prices that wipe out its higher cost competitors. An oil field with cheap lifting costs still makes money when flashy deepwater projects have been mothballed. Diversified economies survive. Countries that use resource booms to build manufacturing, services, and technology sectors don't die when the commodity cycle turns. They feel the hit, but they adapt. The resource becomes one income stream among many, not the only lifeline. Financial buffers survive. Sovereign wealth funds, accumulated surpluses, and low public debt give governments options in downturns. They can smooth out the shock instead of amplifying it. In contrast, countries that treat every boom as a reason to borrow more discover in the bust that nobody is eager to lend to a debtor whose collateral just dropped in price. For individuals, skills and mobility survive. A worker with one narrow expertise tied to a single commodity in a single town is extremely vulnerable. Someone who can move industries, regions, or roles has far more resilience than most balance sheets. And above all, understanding survives. The people and institutions that remember that this is a cycle, not a destiny, tend to be standing when the music stops. Whenever the next headlines scream about a new supercycle, whether for oil, copper, lithium, or something we haven't yet fixated on, the pattern will be the same. Experts will say this time is different. Producers will say the old rules no longer apply. Politicians will say the boom is proof of their genius. History will quietly disagree. The useful question, for anyone trying to navigate this, is not, will this commodity go up or down next year? It is, what stage of the story are we in? Are we in the neglected years, when investments are starved and nobody cares? Are we in the early phase of a genuine demand shock? Are we already deep into euphoria, with projects being justified by price charts rather than sober math? Or are we in the overbuilt phase, where supply is locked in and demand is quietly rolling over? You don't need to predict the exact peak or the perfect bottom. You only need to avoid confusing a temporary windfall with permanent reality. Every supercycle is a transfer, from patient to impatient, from disciplined to overconfident, from those who understand that the ground under their feet can move, to those who build monuments on it and assume it will never shift. When boom meets bust, it looks chaotic. Prices swing, headlines scream, balance sheets implode. But underneath the noise, the same pattern plays out as it has for over a century. Scarcity, response, excess, reckoning. The only real choice is whether you build your plans on the boom or on the knowledge that the bust is already on the way. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look. Is this conversation helpful so far?